America's cereal, soda, and soup companies are having a rough 2018. General Mills, Campbell Soup, Hershey's, Pepsi are all failing to convince investors that they have a plan to navigate shoppers' changing tastes. The consumer staples sector is at the back of the pack in the S&P 500, down 13% this year. It's on track for the worst year in a decade. Recently, Campbell plunged 12%, its worst day since 1999 after CEO Dennis Morrison abruptly retired. Campbell announced review of its entire lineup, including soup, and also leaving the door open for breaking up the 149-year-old company. It's part of a broader problem. Large consumer goods brands lost market share to small competitors from 2011 to 2016 for the first time in 50 years. According to Jim Brennan, a senior partner at Boston Consulting Group, the threat is everywhere. Let's take a look. 2018 has been a perfect storm for big food. Sales growth is stalling while oil, freight, raw material, steel, and aluminum costs rise. In the past, inflation wouldn't have been a major issue for these legacy brands. Their size, supply chain, and enormous TV advertising budgets allowed them to muscle out competitors and maintain high prices. You didn't have tons of competition, and the superior economics just continued. But they don't have the luxury anymore. Their business models and pricing power are crumbling as the retail and grocery industries consolidate, consumer allegiances fade, and low budget digital advertising campaigns sway shoppers. Walmart, Amazon, Target, and Kroger are waging a price war that has spread to the rest of the retail and grocery industry. The pricing battle has changed shoppers' expectations of how much a box of cereal or a bar of soap costs. If suppliers don't play ball on prices, Walmart can always put products in the back of the store where shoppers can't find them, or Amazon can send them to the bottom of its search pages. The growth of cheaper private labels and discount stores like Dollar General, Dollar Tree, and Germany's Aldi have limited big players' ability to raise prices. Amazon, for example, is building out a stable of its own food and household essentials. It launched WAG, a dog food line, earlier this year. Mass-produced brands are not the only game in town. Scale is less important in the digital age when an entrepreneur with a new idea can reach a huge audience online or through a viral ad on YouTube or Facebook. Amazon provides a valuable platform for small brands to gain traction. Brands no longer have to coordinate with local grocers and large chains to get visibility in store. Household care producers have also been caught flat-footed. Clorox, Procter & Gamble, Kimberly-Clark, and Colgate-Palmolive are each down around 20% this year as investors question their strategies. Is buying out the competition the answer? The companies we've talked about have attempted to reshape their lineups and scoop up newer rivals to boost sales. Over the past year, General Mills bought pet food company Blue Buffalo for $8 billion. Campbell acquired Snyder's Lance Snacks for $5 billion, and Hershey purchased Skinny Pop popcorn maker Amplify Snack Brands for $1.6 billion. Recently, Oreo maker Mondelez bought Tate's Cookies for $500 million. But corporate shopping sprees alone are not enough. Acquisitions can raise corporate debt and hit profits. And as if these challenges weren't enough, the industry faces another headache: higher interest rates. Consumer staple stocks are considered safety plays that offer large dividends. However, they are less appealing to investors in an environment where bonds offer similar returns with little of the same risks. So, let's now take a quick look at a few consumer staples stocks. We're looking at the 20-year monthly chart on Clorox, and this is the first of four that I'll go through here real quickly. And you can see that these are selling at fairly good prices. I'm not going to say that they're each and every one of the stocks is ready to be purchased, but keep a very close eye on these because these are good stocks and they will recover. But starting here with Clorox, we can see that the price has declined recently all the way down to the current level, and it's just bouncing on the 50 EMA. Moving down here, the MAC looks like it's still in a pretty steep downtrend, and that's fine. Just continue to watch it. Shown the same here in the histogram, as well as a lot of these oscillators, such as the momentum, price rate of change into the relative strength, stochastic, volume is fine, and then into the Williams. This stock is still heading down, but I think it's a good product or a good company to keep an eye on. Let's go to Procter & Gamble. Symbol is PG. Same thing, 20-year monthly chart. Procter & Gamble. Looking at that, all the way down, it's below its 50 EMA and heading to the 200 EMA. But look back in time to this period here, and then back to the 2009 bottom after the great financial crisis. We're getting into areas that were good purchase points in the previous years. Moving on down here, you can still see though that the MACD, the histogram, and again, all the oscillators are still in perhaps a free fall, but they're still moving on down, haven't necessarily bottomed. But keep a close eye on these stocks because they will bottom. That was Procter & Gamble. Let's go to Kimberly-Clark. Symbol is KMB. Taking a look at this stock here, you'll see probably much the same. It has moved through the 20 and the 50 EMA and heading down still. But you go back into time, similar sort of circumstances happened when the sell-off began well before any stock market crash. And I'm not saying we're coming up to the stock market crash, but there's always that potential. And if you do, some of these stocks may already have sold off and perhaps could provide some protection. Moving on down here, we see that still selling off in the MACD, the histogram, as well as the momentum, price rate of change. Some of these actually might show a little bit of bottom, such as the RSI here on this stock, but a lot of them are still heading on down, so I can't say it's quite time to buy these stocks, but they are getting very ripe for potential. And then the last stock we'll take a look at is Colgate-Palmolive. Symbol is CL. And as in the other stocks, we see the sell-off here. We're below the 50 EMA. You go back in time and you see back here, that was a great time to buy this stock. Again, I want to make sure you understand that you have further fundamental and technical analysis to do before you buy these stocks. But in my opinion, this sector is ripe for a bounce. Moving on down here, again, we see all these oscillators are still heading down, but in my opinion, that's just providing a very good opportunity for some very good stocks. Moving on down here, the last one is the Williams. Back up here to the price chart. I like these kind of stocks because not only are they selling off, a lot of them carry some very good dividends. So keep your eye out. And for today, that's ChewDog Charts. Thank you.